Hello and welcome to Ticker Tapes. Today, we're back in the world of ETFs. We sounded a cautionary note on equity ETF flows 2 weeks ago, highlighting research from Bank of America that said the period of outsized inflows into stock-related ETFs and other funds was finally over. Since then, SPY, the S&P 500 tracker ETF, has fallen by 7.75%, and a net $1.38 billion has left the fund. Year to date, the fund has seen an outflow of $25.3 billion. That's modest in comparison to the $331 billion of assets under management in SPY, but it's big enough to highlight the direction of travel. However, as we have noted before, investors may choose to take money out of an ETF, not just because they've had a change of heart. They may switch because they find an ETF that's a better match for their strategy, or because they find one that offers the same exposure as their current selection, but with lower management fees, and fees matter over the long term thanks to the power of compounding. A low management fee may go some way to explain the $1.88 billion that flowed into ITOT, the total U.S. stock market iShares Core ETF, over the last week. The fund is designed to offer low-cost exposure to nearly all U.S. stocks by tracking the S&P Total Market Index. Of course, low costs don't have any real effect on ETF's performance, and ITOT is down by 24.63% year to date. So we might assume that the investors behind the recent inflows also have a buy-the-dip mindset. DWSH, the Advisor Shares Dorsey Wright Short ETF, which we flagged last week, was among this week's top gainers, adding another 8.95% to take its monthly gains to 16.7%. Though even this impressive return was trumped by the 27.11% monthly gain enjoyed by PFIX, the Simplify Interest Rate Hedge ETF, a fund that first caught our attention in late August. This ETF is really a tactical asset allocation tool which allows investors to bet against the price of 20-year U.S. Treasury bonds. In essence, the fund rallies when long-dated bond yields rise and their prices fall, which, of course, is exactly what's been happening in recent weeks. It's not just bond prices that have been falling, however. Oil and gas prices have also been under pressure, and that's meant some of the year's best-performing ETFs have gone into retreat. For example, UNG, the U.S. Natural Gas Fund, is down 12.22% over the last week and by almost 27% over the last month. Yes, it's still up by 87% year to date, but it shows us that even the most solid and long-lasting price trends can be undermined when narratives change. Though given that gas prices are directly linked to some pretty complex geopolitics right now, we can't explicitly rule out another gas rally heading into the colder months of the year in the Northern Hemisphere.